Hi, my name's Justin Beaton. I am the Managing Director and Founder of Tailored Investment Solutions. Today I want to go through a quick presentation for advisors that are in the business of recommending structured investments to their clients to consider our Tailored Investment Solutions Berkshire Hathaway Units Series 3. Before we get into the product, just a bit about my background. I've been in the Australian capital protected market since 2003, in structured investments since 2004, 2005. In 2009, I created my own structured investment issuing company, and been issuing products linked to Berkshire Hathaway ever since. Berkshire Hathaway has been a stellar performer for all investors, provided a very attractive return, proving that the structured investment space has worked the way it's designed to, especially when the underlying asset goes up. I think unfortunately in the structured investment space, certainly you go back 10 years ago with a lot of the Macquarie Bank products, a lot of people said, hey, structured products don't work. They do work. I don't know of a structured product that hasn't worked in the Australian marketplace. But they do require the underlying asset to go up. If the underlying asset doesn't appreciate in value, then yes, your client doesn't make money. The structure would generally mitigate losses, or depending on the structure that's being used, provide income. But I think over the last 10 years, certainly led the industry with innovation, with ensuring that maybe the downfalls of the products that were poorly explained back 10 years ago should not happen in the future. That's one of the main reasons when you look at the underlying performance of the asset is that I've linked it to Berkshire Hathaway. The key to any investment is that you want to invest into an asset class that has provided superior returns to investors over the long term, consistent, stable returns. I think that's why Australians have a love affair for property, because most people have the belief that property will go up in value in the future. Now, while that's not a guarantee, they've come up with that belief because historically, over the last 50 years, residential property has been a wonderful performer. When it comes to a lot of bespoke structured investments, they link it to alternatives that don't have that track record, that are somewhat speculative. I'm not in the business of speculating. What I want to do is put a structured investment together with an asset class that has a superior long-term track record of providing returns to investors. And there is no other better investment vehicle than Warren Buffett's company, Berkshire Hathaway, which is what I'm talking about today. So look at the presentation today. It is for advisor use only. It's produced by Tailored Investment Solutions for that sole purpose. It's not to be distributed to retail clients. As investment advisors, fund managers, financial planners, whatever your role is in your relationship with the clients, you would understand that past performance is not necessarily indicative of future performance. But we can look at the future and go, hey, with a high degree of certainty that the returns are going to be maybe higher than those that aren't, when they've got such a big track record like Berkshire Hathaway. I'll go through all the risks of the investment, but investors should consider the product disclosure statement, which has been attached to this email. So look at the past investments that I've launched for Berkshire Hathaway. In 2008, 2009, after 10 years in investment markets advising clients, trying to replicate Warren Buffett, I realized that there's an easy way to replicate Warren Buffett rather than doing it the hard way by buying shares, recommending shares, relying on research, whatever it is, your process that you take about when it comes to your investment process. Rather than trying to replicate him, it's easy to get Buffett-like returns. All that you need to do is invest in his holding company, which is Berkshire Hathaway. Now, my expertise comes from derivatives for the last 2 decades, so I wanted to overlay back in 2009, 2010, some form of protection to mitigate the downside risk, just in case the Berkshire Hathaway share price declined in value. So we overlay with Berkshire Hathaway's underlying asset, a structured investment that encompasses capital protection, and with capital protection we can get leverage. With capital protection, the leverage can be up to the protected amount. Here with my structures, you can borrow 100% of the investment. Where a lot of Macquarie products got a lot of people in trouble back in the 10 years ago was that they were variable interest rates, and it was for a very long term, 7 or 10 years for many of them. So if the first year the underlying asset fell in value, then clients were hit with higher interest rates, or if they wanted to redeem, they were hit with a huge exit fee because they were using a structure called CPPI, which is Constant Portfolio Protection Insurance. Here we use the core bond structure. How we outlay it to the client is that they pay for everything up front. So it's fixed 4.95% interest rate, 2.2% is the hedging fee that they outlay up front for 3 years. That way that they can go about gaining a limited recourse loan. That's good for 2 reasons. One is that, look, if the underlying asset, being Berkshire Hathaway in this case, plummets in the first 3 months, clients can merely walk away. They wouldn't walk away because they've prepaid the cost for 3 years, but there's no unexpected additional money that they need to top up into the investment. Secondly, the other good thing about a limited recourse loan is that self-managed super funds are eligible to participate and take out the internal gearing. So in 2010, April 2010, I launched my first Berkshire Hathaway investment. We gained a fair amount of publicity at that time on the back of the first company in Australia, or actually the world, that launched a capital protected investment over Warren Buffett's company, Berkshire Hathaway. It was a 3-year term, very similar to trade to the investment that we have available right now. Now, Berkshire Hathaway share price over the 3 years, it went up 29.68%. The investment return on our investment, our structured investment, was 63%. The reason because of the outperformance was simply because of the internal leverage built into the product. In July 2010, a few months later, we came out with our second product as we had further demand for the investment. Berkshire Hathaway share price was up 38%. Investors for our investment over the 3 years made 94%. October 2010 came out with another one. Berkshire share price was up 39%. We made 95. January 2014, 33%. We made 50. April 2011, which matured in April 2014, 47% was underlying share price appreciation. Investors for our structured investment made 109%. There in June 2011, the Berkshire share price was up 67%. Our investors made 202. So as you can see, when the underlying asset performs well, structured investments work extraordinarily well to accelerate returns because you get the benefit of the leverage for this structure. So we've outperformed in every occasion. The other thing that's consistent across here is that at no time has one of the structures actually gone down in value. We don't have an investor that's lost money out of the Berkshire Hathaway series. And that's simply a function of choosing an asset class that's got a 50-year track record of providing returns. Sure, there will be at times, if we keep coming out with Berkshire Hathaway investments, that the underlying asset does not go up in value by the cost of the hedge up front. But at this stage, out of 8 of them, all of them have made money. The worst performing investment has made 50% over the 3-year period. The average of all of those investments, even the ones that are yet to mature, is 93.58%. The average 3-year return. Now, arguably for me over the last 8 years, that is the best performing investment that has been in my personal investment portfolio. It's been the best investment that my clients have invested in. Arguably, I don't know of a better investment across Australia during that time. So a lot of people go, oh, look, you've done well, which is great, but all that I'm doing is backing Warren Buffett. I'm not selecting the stocks. I've got nothing to do with the investment process. All that we're doing is overlaying capital protection and leverage through a structured investment with Warren Buffett's holding company, Berkshire Hathaway. Warren Buffett is born in 1930. Look, he's regarded as the best investor of all time, the Oracle of Omaha. He's certainly one of the most influential people. Currently, he's the second wealthiest man alive behind his good mate and fellow director of Berkshire Hathaway, Bill Gates. More on Bill in a moment. More importantly is the Berkshire Hathaway performance. Now this is a photo of the performance which is on the front cover of his annual letter to shareholders, which comes out in February every year. This is the most recent one. What's important here is to actually look at the column, which is the first one, which is the per share book value of Berkshire, the either increase or the decrease in value of Berkshire Hathaway stock. Now, if we look there back to 1965 when Warren Buffett took over the reins, there has only been 2 times where the book value of Berkshire Hathaway has declined, which is in 2001, it went down 6.2%, and then 2008, it went down 9.6% as a result of the global financial crisis. What's important to look at, though, is the returns on the upside. Because while it's a share market investment, Berkshire Hathaway is listed, it's more of a listed fund. Because what you're buying is a holding vehicle of the 100-odd companies that Berkshire Hathaway holds either 100% or indirectly as a large shareholder. So while the downside risk has only been 2 years that it's declined both less than 10%, we still get equity performance on the upside. So there's a 59, 31, 24%, 35%, 19, 31, 40, 32, 48. If we go more recently, 18, 10.7, 14.4, 13, 19.8, 18.4, 21. So as we can see, we get equity upside growth potential, yet not necessarily with the downside risk that equities involves. That's certainly been the case for the last 52 years. The average compounded share price return of Berkshire Hathaway has been 20.8%, making it the best investment vehicle of the modern era. That's an average annual return of 20.8%. It's phenomenal. There's a share price since the 1990s. Now, when we first came out with the investment, there was a few skeptical people in 2009, 2010, and said that there's no way that the share price will go through $100,000. It was trading at around $90,000 at the time. This was about here where we did the first trade. And people go, nah, look, Berkshire Hathaway's over. A lot of people said, well, Warren Buffett's going to die. What's going to happen? He hasn't died. Not disputing that he's getting old and getting close to either retirement or passing away. Hopefully for his sake, it's the former rather than the latter. But a lot of people said it's not going to go through 100,000. Well, it did. And it didn't take long to get to 150. A lot of people at 150,000 said, nah, it's not going to go through 150,000. Well, it did. Went above 200. It's now trading at $255,000 a share. Any person that's tried to pick the high of the market of Berkshire Hathaway has soon been proved wrong. One thing I like about investments is when they start really low and they've got that J curve all the way up. When that time frame spans such a large period, that should give us a high amount of certainty that similar returns can be continued. Notwithstanding, look, there's years of the market and Berkshire Hathaway share price declining. There we've got the late 90s, the tech bust. Here we've got in 2008, 2009, the GFC. So it does fluctuate the share price with the overall market. It's that long-term trend of outperformance that I believe makes it a great investment to look at considering. Average return 20.8%. Now, if you look at a dollar invested back in 1950 in Berkshire Hathaway would be worth over $1 million today had you invested in Berkshire Hathaway. Now, the US share market has been a solid performer, been one of the best economies to own over that period. Yet a dollar invested on the US economy, as measured by the S&P 500, would be worth less than $1,000 over that entire time frame. Still pretty good, right? But the difference between 10% that the S&P has appreciated over that time and Warren Buffett's return of 20% and the benefits of compound interest means that the returns are magnified significantly in dollar terms as time passes by. Now, I'll give you a bit of an idea about Berkshire Hathaway. Berkshire Hathaway is the 4th largest company in the world, which a lot of people find like really outstanding in that they don't know the brand Berkshire Hathaway, yet it's bigger than ExxonMobil as an entity. Apple's the largest company, Google's second, Microsoft third, Berkshire Hathaway is the 4th largest company in the world. There's actually less than 30 staff that work at head office at Berkshire Hathaway, because after all, it's just an investment vehicle. It's important to make that distinction. While there's only less than 30 people at head office, obviously at the subsidiaries that Berkshire Hathaway owns, there's a lot more. There's hundreds of thousands. As a biggest company that Buffett owns is insurances, Geico. If you've gone to the United States, turned on the TV, you'd see the green gecko. That's 100% owned by Berkshire Hathaway. At the recent AGM that I attended, which is 2015, I'm attending the third one in a few weeks' time, that AGM, he was asked what's the most important investment advice he's ever received, and that was, according to Warren Buffett, to understand the insurance business. There's not so much the insurance like underwriting people or companies or properties. It's the float that they've got to use to hold at any one time just in case there's a claim on their policies. It's how they invest that float that's made Warren Buffett so successful. Burlington Northern Santa Fe, which is one of the biggest railway companies in the United States, transport company. NetJets, American Express was one of his first and most successful investments that he made back in the 70s, and he's held it since then. IBM, a company he's bought more recently. Kraft Heinz, another company that he's acquired more recently. Coca-Cola, he's held that for decades. Goldman Sachs, company that he acquired a stake in as a result of the GFC. Wells Fargo, largest shareholder. General Motors, Bank of America, Apple. They're some of the big brands that Warren Buffett owns companies in through his Berkshire Hathaway investment company. One thing that he does do, and is quite simple at, is that he doesn't believe activity makes money. He sits back waiting for outstanding opportunities, and when those opportunities come around, he has a large swing. His view is he looks at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. His big belief is that you've got to hold cash when everyone else needs it. And the GFC was a case in point where not many people had cash, so Warren Buffett's phone was ringing off the hook for investment opportunities, where you could buy a stake in outstanding companies and negotiate very attractive terms on that basis. So if we look at some of the purchases that he's bought since the GFC, Goldman Sachs, he invested $5 billion in preference shares, but he had the right to convert those preference shares at a discount to market. That's arguably, from my view, one of the best investment deals I've ever seen anyone and Warren Buffett negotiate. There was pretty much no downside, 100% upside in the share price of Goldman Sachs, and he enjoyed a 10% income while he held the preference shares. Burlington Northern Santa Fe bought 77% of the stock for $26 billion. That was the remaining stock that he didn't own. Lubrizol, just on a $10 billion. Now, while the Goldman Sachs deal was like a deal of a lifetime, Bank of America called him up in 2011 and said, hey, you know that deal you did with Goldman Sachs, would you like to do it with us? He said, yep. So he bought $5 billion worth of Bank of America preference stock on the same terms as Goldman Sachs deal. IBM, Heinz, then he bought Kraft and combined them. Largest ever acquisition, Precision Cast Parts, which was for $40 billion. In 2015, he made his first investment in Australia by making an investment in IAG. Now, it wasn't just an investment in IAG, but 20% of the insurance premiums go straight back to Berkshire Hathaway that IAG writes for underwriting the issue. So it's very beneficial for Berkshire, more so than Insurance Australia Group. When you talk about looking at market folly rather than participating in it, when the oil price fell down last year, beginning of last year, to below $30, he realized that it wasn't sustainable to hold at those levels, so he made a big acquisition in Phillips 66 to take advantage of that oil price slump, and has made a truckload of cash since then. So we look at all those deals. There's not that many, given that we're talking about a time frame over 8 years. He's currently sitting on just under $100 billion of cash, waiting for what he refers to as elephant-sized acquisitions. Then he's been buying stock in Apple, and that's probably more of a decision from the guys that are looking to take over from Warren on the investment front, which is Todd Coombs' purchase. But more on the future in a moment. So 2015, I attended the 50-year anniversary of Berkshire Hathaway. 50,000 people turned up. there's the auditorium, and it's like that every year. There was a line 2 hours before they opened the doors for people waiting to get a seat. Now this is a very important photo. That's Warren Buffett on the right. We have his right-hand man, Charlie Munger, in the middle, and then we have who I believe will be taking over as CEO, chairman, when Warren does retire or pass away on the left, which is Bill Gates. Bill Gates, since the 90s, has been on the board of Berkshire Hathaway and been a key person for the decisions of the overall company. Why I believe he's going to take over the realm is that his time at Microsoft is he's moved on from then. Where Bill spends most of his time is focused on his charity work. He has the Gates Foundation. Now, why the Gates Foundation and Berkshire Hathaway are so important is that when Warren Buffett does eventually pass, he's agreed to donate 97% of his Berkshire Hathaway shares to the Bill Gates Foundation. So indirectly, Bill Gates controls the largest stake of Berkshire Hathaway. He will become the largest shareholder indirectly through the ownership of his charity. And this is why I'm launching the investment right now. I believe in the next 3 years there's going to be a change at the helm of Berkshire Hathaway. I believe the share price is going to be massively re-rated in the market to the positive as a result. Why I believe that is what Warren and Charlie do and have done so well for the last 50 years. Obviously, if they move on, like the profits of Coca-Cola, the profits of American Express are not going to be affected. Those companies pay a dividend, those dividends get paid through to Berkshire Hathaway, and then they sit in Berkshire Hathaway, and what's happened in the past is that Warren Buffett and Charlie have allocated that capital to other investments. That has been their role, is the allocation of Berkshire Hathaway's capital. That's what they've been so good at, and negotiating great terms like those ones I've just spoken about since 2008. However, they haven't paid a dividend to investors since like the 60s. In fact, there's only been one time Warren Buffett has paid a dividend to shareholders, and he said that that's one of his biggest regrets. He says if he pays dividends out, he's actually saying that investors can get a higher return than what he can. History shows that's certainly not the case. But why I believe it's going to change in the future is that when your largest shareholder is a charity, you need income for that charity for them to go spend on research and development, come out with a cure of polio. It's been a big thing for Gates over the last few decades, or whatever he wants to spend the money on to change the world. If you just sit on Berkshire Hathaway stock and it's not paying dividend, then the charity can't implement change. The other thing is that it's going to change it from being a capital growth story to an income-paying stock. While the largest shareholder is the Gates Foundation, it needs income to be able to do what it needs to do, is that the people that are allocating the capital, Warren and Charlie, no longer exist in the business. This is what I believe is going to happen in the future. So if they're out of the business, then there's no one there that has got the track record of Warren and Charlie to allocate the capital. Therefore, they may as well pay those distributions through to investors. So when it goes from being a capital growth story to an income-paying stock, I believe that the share price will be re-rated massively on the upside. The other thing that I believe that has held the share price back despite its stellar performance even more recently is the fact that there's been a fair amount of uncertainty over the decision as to who will take over when these guys move on. Because I'm just speculating that Bill will take over as a fairly educated guess. If they do move on, I believe a lot of people that have been sitting on the sidelines will buy the stock, especially if it's going to have a positive story of being an income-paying share. The average yield on the United States share market is less than 2%. It's very different to here in Australia. So we've got a company with such a stellar portfolio of investments like Berkshire Hathaway starts paying 4 or 5% as an income out. It's going to be very attractive. But the overshadowing, the overhang that's sat in the stock is that people have sat in the sidelines being uncertain, going, look, we're not too sure what's going to happen when Warren Buffett and Charlie move on, so therefore we'll not invest. Conversely, if they've already held Berkshire Hathaway, a lot of them go, well, I don't want to take the risk of what's going to happen when they leave, so I might as well sell and take profits now. So that's a lot of selling that's existed that wouldn't normally be underpinning a stock. So once those two things are overcome, because the market dislikes the most uncertainty. It's not whether it's good or bad news. There's plenty of bad news that comes out and the share price goes up of an underlying company. What the market dislikes the most is uncertainty. So once that uncertainty is eroded from their company, the share price should increase in value. I think that will happen with the company having increased confidence when Bill Gates takes the reins. There we have 2013 AGM, which is the first time I attended the AGM. You got a photo there on the left. As you can see, who's on Warren Buffett's side playing ping pong is Bill Gates. And over the 3 days at all of the AGMs I've attended, that's been pretty much the place Bill Gates has camped himself. He's next to Warren Buffett. Warren Buffett has been grooming Bill Gates to take over the role as chairman for a number of years. At dinner, I was lucky enough to choose the restaurant that Warren Buffett and Bill Gates ate at. As you can see there, I think they're having a Coke Spider. I don't think Warren Buffett drinks anything less than Coke. It's just Coke. Being the largest shareholder of Coca-Cola, that's fair enough. They're pretty basic individuals, more so Warren than Bill. But again, there they are with their families. These are the two guys that I believe are the past and the future of Berkshire Hathaway as a company. There you go, in the forefront of that photo that I've taken, that's Bill Gates. There's Warren, again, next to each other. So I think, talking about Bill Gates a lot, but I think the company is in good hands. I think the future and the outlook of Berkshire Hathaway looks even better than what we've experienced over the last decade due to that uncertainty being evicted from the share price. So Warren Buffett way, what he looks for in a company is, first and foremost, it has to have quality management. Secondly, it has to have a long-term track record of providing superior returns to investors. Thirdly, it's got to be simple and easy to understand business model. 4, it needs to be trading below intrinsic value. These are Warren Buffett's 4 main criteria to invest in any company. For me, the company in the globe that represents all of those 4 is the best opportunity to be buying right now is Berkshire Hathaway. Quality management, proven track record of providing superior returns to investors. It's got a long-term track record, 52 years of providing 20.8% average return to investors. It's simple and easy to understand business model. This is just a listed investment vehicle that owns shares in some of the largest companies and institutions in the world. 4, it's trading below its intrinsic value, simply because of that stock that's overhung the share price as a result of the uncertainty with both Warren and Charlie getting on in life. So let's look at the specifics of the investment. Tailored Investment Solutions, Berkshire Hathaway Series 3 investment. As a company, Tailored Investment Solutions comes out with 3 things. We value transparency, innovation, and integrity. The innovation is, I believe I've been a leader in the innovation of the structured investment space over the last 10 years here in Australia. My previous company, I sold out to the listed company Sequoia. It still issues structured investments. There's a period of time where I decided not to issue structured investments, which is a few years ago, 2014. I was able to come out with Tailored Investment Solutions to get back into the structured investment space as an individual. Integrity, look, I'm not a big believer in charging high interest rates like other structured investment issuers have done in the past. We want to pass on the cheap cost that we can get to hedge the company. The underlying investment, where I do make money, is a 10% performance fee. So any amount that's paid out to investors, I take 10%. So if there's nothing that gets paid out to investors, I get paid the same as investors, which is 0. So it aligns my interest with that of the end investor. So I'm naturally going to come out with investment that I believe offers the highest growth potential, not just for your clients or my clients or me as an individual investor, but also for me as the issuer, because that's where my money is going to be derived from, rather than just getting paid a guaranteed income, irrespective of what happens for the performance through higher interest rates. So it gets exposure to Warren Buffett's company, Berkshire Hathaway. Currency movements, it's only on currency movements on any gains. The investment amount is 100% hedged for currency. There's 3 risk management strategies built into the investment. There's dollar cost averaging over the first 2 months. There's 3 observations on the way in, 3 observations on the way out, just to smooth out the entry and the exit of the investment, to ensure that the share price fluctuations in that time doesn't have, in the first 3 months, the last 3 months, doesn't have a material impact on our entry level or exit level. Capital protection through a hedge. And the third one is, what we actually do is we harvest the growth along the way by paying out coupons. So while Berkshire Hathaway doesn't pay a dividend, we pay out coupons, which is linked to performance. So if Berkshire Hathaway share price is up 10% in the first year, we pay out 10% to investors, or 9%, and I take 1. So they get cash returned to them at the yearly anniversary and the end of year 2, provided the underlying asset, the reference asset, has appreciated in value. If it only goes up 5%, they get paid 5. If it goes up 20, they get paid 10. The other 10% stays in until the investors redeem, or the maturity of the investment, which is 3 years. You borrow 100%. The effective interest rate is 4.95%. There's a 2% currency hedging fee. Of course, it's a limited recourse borrowing arrangement. It's self-managed super fund suitable. Quantified downside risk, because we're prepaying 3 years up front, that's a maximum amount a client can lose. So there's no surprises like there had been 10 years ago in some structured investments issued by other issuers. Every quarter, investors can redeem, but that should be considered as a profit-taking mechanism. As I said, there's potential for yearly income distributions through coupons, which is based on gains of the underlying into 3-year term. 100 grand example, 100,000 units, $1 a unit, total notional leveraged amount for Berkshire Hathaway is 100 grand. Investment amount is 20,850, which is 3 times of that 4.95% effective interest rate and the 2% hedging fee. An advisor service fee, that's up to you to charge with your client. You can choose not to charge an advisor fee. You can choose to charge an advisor fee. That's a discussion that you have to have with your client. We collect the amount, you just fill it in the application form. We collect that advisor fee amount on your behalf, and then we pay it through to you or your dealer group once it's been all finalised. So if you did charge a $2,200 advisor fee, the total outlay for the client is $23,150. That's the maximum risk and the maximum outlay for the full 3-year term. If Berkshire Hathaway share price doesn't go up in year 1, doesn't go up in year 2, doesn't go up in year 3, investors will lose that $23,150. Well, I was talking about the coupons being paid as a risk management. Let's say it's up 10% in year 1, clients get 10 grand. Another 10% in year 2, they get another 10 grand. And then the 3rd year, the share price tanks and falls over. Then clients have got $20,000 in their bank account and their outlay was 23. So their risk has been reduced by harvesting the growth along the way. As an example, let's say Peter and Ann, the client here, they've got a self-managed super fund. They want to gain some international share market exposure. They don't want to do it through a fund where they charge high fees for very poor performance or for sub-Buffett-like performance. They like the idea of Warren Buffett, so they want to diversify. They want to reduce fees. They're taking control of their super, and it provides leverage. It's tailored for their super fund. So they outlay $23,150 of, call it a $200 or $300, $500,000 super fund. That gives them 100 grand exposure to Warren Buffett. So as an investment manager, it doesn't take much capital out of their portfolio, yet it does provide a lot of benefits in that clients gain exposure to Buffett, international diversification, the ability to earn income, and also high growth capital potential, as we saw with the performance figures of the first 8 investments that I've rolled out over the last 8 years. So there's a lot of positive things you can go to your clients with this. It's, I believe, a huge value add. It's something bespoke that no other investment advisors are going to their clients and offering. So it's a great way for you to improve the relationship with your clients, to offer it to them as something that's a little bit alternative rather than just buy property or buy shares or buy Platinum Asia Fund. Key risks, look, obviously while Berkshire Hathaway has had a 50-year track record of providing superior returns to investors, there's no guarantee that the underlying share price of Berkshire Hathaway is going to appreciate for the next 3 years. The performance is going to be influenced solely by the performance of Berkshire Hathaway, and then secondly for the currency, but the currency only comes into play on any gains. How that works is, let's say Berkshire Hathaway is up 10% in US dollars and the currency appreciates in our favor by 20%, then the performance is 12. So it's 20% on the 10, which is 12. If it goes against us by 20%, the investors will receive 8. So currency does have an impact, but only on the gains to investors. Counterparty credit risk, it's an investment grade bank. It's one of the leading investment banks or can be one of the leading banks, will be, but there's a panel that we use of investment banks in the world. Their average performance, they speak for themselves, like average return of 93%. I wish more people invested in them in the past because the returns have been quite stellar. A lot of people say, well, look, what happens when he passes away? And I think I've addressed that. Like the easiest comparison or the most similar comparison to make, I think, is to Apple with Steve Jobs. Steve Jobs passed away of cancer in October 2011. Now, because he had cancer, he wasn't old like Warren Buffett. Warren Buffett's 87 years of age, but I suppose the similarities are there in that we knew for a period of time that Steve Jobs was eventually going to pass away of cancer. Here, Warren Buffett's eventually going to die of old age. I don't know when. We're obviously closer to it today than what we were 10 years ago. I don't think that's a reason not to invest because I think the share price is going to perform for Berkshire Hathaway similar to what happened to Apple's share price when Steve Jobs passed away. I think this highlights the fact that people sit on the sidelines or sell, which causes a fair amount of selling pressure on the underlying stock because of the uncertainty that surrounds the outcome of when such a dominant leader of a company exits, whether it's through cancer or old age. But when that uncertainty is evolved or overcome, the share price of Apple increased by 72% 12 months later. That's what I think may occur to Berkshire Hathaway's share price when Warren decides to retire for those reasons I mentioned before. So look, the investment is open now. It's already open. It closes on the 11th of April 2017. We take a position in the market late April. If you'd like a copy of the product disclosure statement, I think one was attached to this email. There was also a flyer. If there's any more information that you need from us, if you want to talk to me directly, then by all means, send me an email. So look, today was just really an introduction to who we are, what we do, and how the Berkshire Hathaway shares or structured investments have performed over the last 10 years. Look, I think structured investments are a solid investment to consider. I think the performance of the past has got nothing to do with their actual underlying structure, but more the underlying asset. If we're choosing asset classes that have got a long-term track record of providing superior returns to investors rather than choosing the next quick buck scheme or speculative underlying, then I think a lot of investors make a lot of money out of structured investments, as we can see by the performance of our Berkshire Hathaway investments I've launched over the last 8 years. So thanks very much. I hope that we can work together in some shape or form. If there's any questions or information, as I said, drop me an email or call me directly on my mobile. Thank you very much. Happy investing, guys.